Different Forex Markets. As you can see from the image below, the Forex market completely dwarfs the three next biggest markets. In 2016, it had a $5 trillion average daily turnover. But this $5 trillion is actually made up from many different FX submarkets that you can trade in. The one that most retailers trade in, which is also one of the largest and is the market GLS equity trades in, is called the Forex Spot Exchange Market. The spot exchange market is one of the largest for many reasons, but mainly because it is derived directly from the real underlying asset. There are many different FX markets that you can trade in, with more and more being created all the time. Here is the breakup of largest markets displayed the average daily volume from 2016. 2.383 trillion in foreign exchange swaps, 1.654 trillion in spot transactions, 700 billion in outright forwards, 254 billion in options and other products, 96 billion currency swaps. Here are the four main markets available for retail traders: Forex Spot Market, Forex Futures, Forward Contracts, Forex Options, Forex ETFs. This academy is focused on the Forex Spot Market, but we will go over each of these four different markets briefly on the following few pages. The Forex Spot Market is decentralized. This is called OTC, or over-the-counter. It means there is no central exchange that all the trades go through. For us retail traders, our trades, in general, are passed on from our brokers to their liquidity providers and are executed directly with them, but sometimes can be traded directly with other traders. Or the broker can take the other side of our trade, not an ideal scenario. Most brokers' liquidity providers come from the interbank market. And depending on the total combined amount of volume clients trading the broker has with this liquidity provider, the better the price they will receive. Larger brokers generally equals better pricing potential. In the Forex spot market, what you are actually trading is a contract that requires delivery in 2 business days. But because we are speculative traders and do not actually want physical delivery of the cash, we roll over these contracts every day. We close the current 2-day contract and open another next day out. No, we don't do this manually. It is done automatically for you by your broker. Most FX traders don't know what happens at all. And to be honest, you don't really need to know. It all happens behind the scenes with zero input from you. But it does happen, and it happens every day at 5 PM EST, unless you close your position before 5 PM. If we let our contract expire, we would need to settle the underlying money in cash. For example, if you were long one lot of the Australian dollar US dollar at 0.78549 and the 2-day contract expired, you would need to give your counterparty $78,549 US dollars in cash, and they would give you 100,000 Australian dollars in cash. When we are just trading FX for speculative reasons, we do not want to go to all the trouble and expense of dealing in the actual underlying product. There is simply no need to. What does all this mean for you as a trader? Nothing really. It's just good to know how it works. Do you need to understand all of this to be a profitable trader? No. Do you have to do anything to ensure you don't get delivered a pile of cash? Nope, it all gets done automatically for you. Note, there is more on this under the rollover, swap, and interest section of this course. Forex Futures Market. Forward Contracts. Futures are simply contracts. They are contracts to either buy or sell a certain asset at a specified price at a future date and time, hence called futures. This market is traded via a central exchange like the Chicago Mercantile Exchange, CME, which means when you make a trade in this market, the exchange is the counterparty to every single trade, and everyone sees the exact same price. This can be a great market to trade, but it is also only possible to trade this market during Chicago business hours, and is a lot less liquid than the FX spot market. Forex Options. An option is a contract that can either be bought or sold and gives the buyer the option, but not the obligation to, buy or sell an asset at a specified price at a future date and time. Seller the obligation to, if asked to, buy or sell an asset at a specific price at a future date and time. Options are also traded on a central exchange, such as the Chicago Board Options Exchange. However, the disadvantage in trading Forex options is that market hours are limited for certain options, and again the liquidity is a lot less than the FX spot market. There are also binary options. These are a form of credit spread generally traded with dodgy market makers or brokers. Options trading can be fairly complex, and are not the topic of this course. So this is just a brief overview letting you know there are other FX markets to trade in. Forex ETFs, Exchange Traded Funds. An ETF, or Exchange Traded Fund, is a marketable security that tracks an index, commodity, bond, currency, or a basket of any grouped assets similar to an index. Like options and futures, ETFs also trade on exchanges, so again you are limited to exchange hours and potential liquidity issues. Because ETFs are not real, tangible assets, they are a form of derivative, and they are issued by third-party fund managers and product issuers. They may also involve issuer-specific counterparty risk. For the remainder of this course, we'll be just focusing on the Forex spot market.